Hi, I'm Roger Montgomery and welcome to this week's Video Insight. Last year we generated very high returns for our investors, in the double digits in many cases. But this year is going to be a lot tougher. Now I know I said that at the beginning of last year as well, but the difference is this year is all about interest rates. You see, the United States would like to raise rates, but they shouldn't, and China would like to lower rates, and they can't. The uncertainty that this generates is going to translate to a great deal of volatility for financial markets this year. Of course, that's why we have a fair bit of cash to take advantage of them. But let's take a step back and look at the situation in China and then in the United States. In China, lowering interest rates would certainly stimulate demand, which would generate growth in China. But of course, the problem with doing that is you cause the currency to decline, particularly against the US dollar. And that would cause mayhem, not only because Chinese manufacturers would be less competitive with a lower currency, but the country over the last 8 years has taken on something like $10 trillion of debt, with a tenth of it in US dollars. So it would cause mayhem in China because of the highly indebted nature of many companies. These companies would either fail or they would be allowed perhaps to limp along by the People's Bank of China, neither of which is a great outcome. In the United States, the situation is very different. Janet Yellen at the Federal Reserve would like to raise interest rates. But recently, Ray Dalio warned of the dangers of the Federal Reserve raising rates too much or too soon. You see, quantitative easing only works effectively when there's a sufficient risk premium on alternative assets to cash, such as real estate, bonds, or even shares. Once that risk premium is reduced, quantitative easing becomes less effective, and that's where we are now. You see, in the early stages of quantitative easing, there was a sufficient risk premium to attract investors to invest in these other assets. But those assets have now been bid up to the extent that that attractiveness no longer exists. And so it's a little bit like pushing on a string. Quantitative easing is ineffective at stimulating demand now, but the corollary is that it's more effective at reducing demand when it's wound back. And that's where we are today. If the United States raises too much or too soon, it could have a significant detrimental impact on the economy. And remember that interest rates are so low that the Federal Reserve doesn't have much room to lower rates to calm the market and stimulate the economy again if it were to fall into a recession. Those two dilemmas, the dilemma facing China and the dilemma facing the United States, is difficult for Australia to navigate, and certainly difficult for investors. And that's why we currently have a great deal of cash in our funds, and why we launched the Montaka Fund, to be able to take advantage of declining markets and to also take advantage of cheaper prices. I look forward to commentating and discussing these issues with you further as the year progresses and as these events transpire. In the meantime, please follow us on Facebook and Twitter, and I look forward to seeing you next week.